We all know that famous Warren Buffett investment quote about waiting for a fat pitch. A lot of people like that quote, and they like to use it to describe their own investing process. But they're using it wrong. They're using fat pitch like it's a guaranteed home run. And that's not what Warren Buffett meant. This is the original quote. The trick in investing is just sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, "Swing, you bum," ignore them. You see, Warren Buffett is a big fan of Ted Williams' book, The Science of Hitting. And in that book, Ted Williams takes the standard strike zone and his strike zone and breaks it down to 77 smaller baseball-sized strike zones. And he overlays that with his batting average in each one of those zones. And as you can see, and as you probably expected, the fat down the middle baseball pitch is where he had his highest batting average. But arguably one of the greatest hitters of all time only got a hit 40% of the time on that fat down the middle pitch. Once he made contact, there was a myriad of external factors that dictated whether that contact turned into a hit. It was not even a guaranteed home run. But Ted Williams knew that this was his greatest zone of opportunity to get a hit. What Warren Buffett was saying was find your zone. Find the area where you have your highest batting average. And then focus on every pitch within that small zone. Ignore the rest. Don't worry whether or not it's going to be a home run. Just make contact. Some are going to be singles, some are going to be doubles, some are going to be home runs, and some are going to be outs. But focusing on this highly productive zone, you increase your odds of success. Now, it's not a guarantee. Just like with hitting, there's a lot of myriad external factors that are going to dictate whether your investment becomes a winner or a loser. But you won't know until you make contact. So don't miss out on an opportunity while you dither on whether or not it's going to be a home run or a single. Just swing at that pitch. And before I move on to what I use to find my fat pitches, just a reminder that this topic was sent out to newsletter subscribers before it became a video. If you want to subscribe to the Yield on Cost newsletter, there's a link down in the description. Now, my filters. A consistently high return on invested capital metric is a good indication that a company has a strong competitive advantage and it's worth looking further into. Gross profit margin demonstrates competitive advantage. It is the purest expression of customer valuation of a product, clearly implying the premium buyers assign to a seller for having fashioned raw materials into a finished item and branding it. High gross margins in relation to its competitors, the industry, and the market in general can show strong pricing power. This can act as an offset to rising input costs. It also creates operating flexibility. The company can increase R&D expenses or marketing or both.
Isn't about the size of the competitive advantage. It's really about what direction is that competitive advantage heading in.
This is mostly a qualitative exercise. You got to think about what drives the business and what can maintain their competitive advantage. But you can measure it quantitatively with return on incremental invested capital. A growing or high return on incremental invested capital means the company still has high reinvestment opportunities for the capital and keeping it in that business to grow its competitive advantage in the future. Declining or low return on incremental invested capital means either the company is investing in suboptimal projects or they're investing in things that are below their cost of capital and destroying shareholder value. Secular growth is long-term growth driven by a persistent shift in demographics, new technologies, and consumer behavior. I want to invest in companies in a secular growth trend because they should grow faster than the overall economy. And then you pair that with a high return on invested capital or a growing return on invested capital, and that combination should create a lot of shareholder value going forward. Dividend initiators and growers. Dividend initiators and growers tend to outperform the market over the long term. There are a lot of high quality companies that don't pay a dividend. But again, I'm using these filters to narrow my field of focus and really get down to a small, highly productive hitting zone. Finally, if a company passes all these other metrics, we want to make sure that we're paying a good price for that business. We don't want to overpay for it.
Shut up and take my money.
And obviously the big difference in this metaphor between investing and baseball is that baseball has a set strike zone.
Up, Acuna takes off and strike three. Not even close. Oh my goodness.
Fat pitch is pretty much a fat pitch for every hitter. Investing does not have a set strike zone. My fat pitch is not your fat pitch. My style of investing is high quality dividend growth investing. It suits me, but that doesn't have to be your style of investing. What Warren Buffett was saying is find your highly productive zone, and then you need to swing away at the opportunities that come down that zone. If you want to learn more about my investing style and what I like to invest in, you can check out this video. And just a reminder that there's a link down in the description to subscribe to the Yield on Cost newsletter.